supposed to create some presentations and videos for this financial independence retire early on how I did it. So this is my first shot at it, not professional or anything, just trying to share information for you all. This is the overview slide. Next slide. The purpose of this is to share how my wife and I accomplished financial independence. Basically try to help the next generation of family, our friends and colleagues. We're not YouTubers or anything like that. This is just for fun. It's just a hobby. Just want to share information for you all. Provide book recommendations and resources so you can go along this journey if this is something you want to do. A little bit about us. I'm Van, 42 years old. Profession was an electrical engineer. Obtained my professional engineering license and my MBA both from Clemson University. My wife's 40. She's a registered nurse. We have one kid. We mainly worked on the East Coast for most of our career, but for the past 3 years, we worked in Hawaii and California. We hit financial independence status in 2022, and we resigned this year, this summer. So a little bit about what FIRE is. So this is from the Fidelity website, so I'll just go there real quick. But first, high-level overview. Financial independence is shortened to FI, meaning have enough assets like investment, savings, or income to cover your living expenses without relying on a job that makes you independent. Doesn't mean you have to quit working. Some people may continue working, but being FI gives you that freedom. And if early retirement is your goal, this is one way to get there. So there's a FIRE movement, and FI is a broader concept that has a lot of variations from lean FIRE to fat FIRE and everything in between. So I wanted to open up the actual Fidelity website. This was published July 2nd, 2025, and give you some of the key takeaways. I mean, if Fidelity's talking about it, it surely is a real thing. Now you know someone, or you may know others as well, that's, became financially independent and resigned. So this is part of their Fidelity viewpoints. They have articles like this, pretty interesting articles. And I wanted to hit some of the high points on this article here. So I already went over what was financial independence. The FI number is the amount of money you need to hit financial independence. It's your personal net worth target. And basically it means it's a point where your savings and investments can reliably cover your lifestyle without a paycheck, possibly all the way through retirement. Everybody's number is different, depends on your lifestyle. So this is how you calculate it. It says add up the annual expenses you expect to have in retirement. That means everything, insurance, travel, hobbies, anything. And they have an estimate of 55 to 80% of your current income in retirement. Step two, it says to multiply that number by 33. So it says to achieve financial independence before 62. Fidelity suggests having at least 33 times your annual expenses, and that's a 3% annual withdrawal rate. So how they do that is, let's say this person, Susan, spends 70,000 a year. Their FI numbers 70,000 times 33, and the reason they got 33 is you divide 1 divided by 33, you get 3%. That's basically how it works. Let me double check that. Yeah, so 1 divided by 33 times 100, you get 3%. This here, that's their opinion. There's a study by Bill Bidkin who recently wrote a book that's coming out on Audible September 30th. I'll listen to it. But he came up with the 4% rule. Here they're using a 3% rule. It's pretty conservative, in my opinion. There's other people that have a similar opinion, but Fidelity, they have to be careful what they publish. But it's pretty close. Oh yeah, here they even said it's a general guideline. And then if you want to become FI earlier than 62, you need to save more just for inflation. And of course, they want to tell you about the retirement planning tool I've used that tool. It's actually pretty good. Helps you estimate, but you have to input a lot of information. We may could do a video about that one later. So here's how the article says how you do it. So step one, tackle high interest debt. Obviously, if you have high interest debt, you need to pay that off because that could mean like a credit card, which is 20 to 30% interest. That'll basically kill you. It'll kill any chance you have to obtain wealth if you're making those type of uh, debt payments or interest payments. This budgeting, whoops, this budgeting, you need to trim your spending. So what I say here is when you think about the best companies in the world, the largest companies where they buy each other out, it's called merger and acquisitions. The first thing they do is they start cutting expenses. They'll relocate their headquarters, they'll combine headquarters, they'll start offering early retirement packages, they'll start layoffs. What they're trying to do is increase their profit and reduce and eliminate redundancies. So if they're doing that, then you should do that as well. You need to look at your budget, see, like here they say, I don't know why it keeps doing that. It says review your recent credit card bank account statements where you can slash spending, because when you cut the spending, you'll have hopefully excess money to pay down that debt or invest. Next, boost your income. For us, for example, at one point in time, like probably 2013, 2014, 15 area, my wife had like 3 jobs. She was working at multiple hospitals. Um, Here they talk about working for a raise or look for a new job where he can negotiate a salary bump. I had a VP tell me once that he looks for a job every 3 to 5 years. He feels like by the third or fourth year, he's done a lot already in that role. He's ready for a new role, and he became like a senior vice president at a large company. So, that's advice from him, what he was telling me. But here on this number 3, they talk about different side hustles like tutoring, walking dogs, selling unwanted items. I had a friend that was a teacher that would do tutoring and also like sell or market tutoring and then get other teachers to tutor for him and then take a little piece of the commission. Basically, he would find and place the student with one of his peers. Number 4, it looks like it says here maximize workplace benefits like 401k. They basically say if you have any matching, you need to do up to the match because that's like free money. That's like a 100% return on your money. But you need to look at the fine print. Some companies require you to put 8% contribution and then they'll give you 6% of that. Some companies give you a 1-for-1 match. You put in 4%, they give you 4%, but you really need to look at the data or the information from the plan. And then it also talks about, a health savings account. That's one of the most powerful retirement tools if you know how to utilize it. We can talk about that another time, but they have links. I'll include a link in the presentation, but they have links within these Fidelity websites that take you to another website that talks about it, teaches you. And then it talks about choosing appropriate savings and investments. I'll talk about my portfolio in a later video, but here it talks about your investments need to grow, and you also need protection from market volatility. My portfolio now is a lot different from when I was in the accumulation phase. I'm in a decumulation phase, so I'm looking to protect my portfolio. And here they talk about competitive interest rates such as CDs and high yield savings account. That's a good thing as well. If you have short-term expenses, you need to ensure that you have a high yield savings account. A lot of people didn't I was surprised that some of my friends didn't know about high yield savings account. So there's a couple bank accounts that you have. You have your normal checking account, you have regular savings account, then you have a high yield savings account or money market savings account. And usually there's not any fees with that. So you should always go for the high yield savings account or the money market savings account. You shouldn't just get the regular savings account that doesn't have hardly any interest. So you have to look at the products at the bank that you're banking with and review what is the actual interest rate that these savings accounts are offering. For my friends and colleagues in high income tax states, you know, those states will also want, pay taxes on those. So there's other ways that you could shield yourself from having to pay state taxes like federal obligations by investing in federal obligations like treasury bonds or municipal bonds. But that could be another video as well. And then at number 6, it says use tax advantage accounts like 401k, IRA. I had a friend ask me, should I do Roth or traditional? And usually the best answer for that is, do you think you will be making the most amount of money now or later? If you're making the most amount of money now, then if you put it in a traditional, you get that tax deduction now. But if you think, 10 years later you'll be making more, then it makes sense to do a Roth now because in the future you'll be making more and you'll be taxed more. So those are some calculations. Maybe we can talk about another time on how you would figure that out. But for the most part, if you're looking to fire or retire early, most likely this is your highest earning year. Myself, we mainly did traditional. And I can share the resources. There's a really good article I read by the Mad Scientist, which talked about that. I used to do Roth 401k, but after I read that article and pondered on it, I went back to traditional. And then there's some additional options like a taxable brokerage account. They provide extra flexibility. You don't have to worry about contribution limits or age. You can take it in and out whenever you want to. You may have to pay taxes. The government always wants, taxes if you made money there. Then the bridge strategy. So if you plan to reach FI before your traditional retirement age, then you need to cover the gap between that time, between you taking out from your 401k, but there's also strategies for that as well. So I thought this was a pretty good article to share for an overview. We'll go back to the slides here. The book resources, I think these books are so good that I had to share it in my overview. The first one is Billionaire Next Door, The Surprising Secrets of America's Wealthy. He did a study, talks about, how the wealthy people actually live. You'll be surprised if you haven't read this book. It's such a great book that obviously it's in my recommendation these days with Instagram and the internet, Facebook, all that type of stuff. What you see is not really how wealthy people are. A lot of those, I guess, reels are not. That's not a good example of how million millionaires are. I mean, there are a lot of wealthy people out there, but for the most part, you would never know unless you read this book. And he talks about some tips and tricks and stuff in this book. Then the next book is Your Money or Your Life by Vicki Robin. And this was her husband or boyfriend at the time, but she's known as I would say, godmother of financial independence. And after I read her book and I was doing a lot of her stuff, it really changed mm, my perspective, and a lot of things she teaches in her book is really good, like tracking your net worth. That's also talked about in the Millionaire Next Door. They talk about, millionaires don't talk about how much they made because if you made 500,000, you spent 500,000, your net worth didn't go up. It talks about, that what they talk about at the country club or where they're meeting and stuff is how much their net worth went up. So a lot of information in this book. So I won't be able to, I'll spend a lot of time just going over it. If I do that, you'll be missing out on the lessons by reading these books. And if if you're super lazy, they have like YouTube videos where it like hits the high points of this book. But I would caution against that because you won't get the experience of reading or listening to the audiobook. You'll be, what I would say is like cheating yourself, because a lot of times you'll listen to something, you'll think about it, you'll ponder, and that helps. I feel like it helps develop the memory for you. So I thought these books are really great. And then there's some Facebook groups. I think these two groups are pretty good. There's also a Fat Fire group I didn't put on here, but like these Facebook groups, like if you're looking to become financially independent, you need to be exposed to to other people who's looking to do the same. And like these groups, people ask questions and stuff. And then other people that are knowledgeable will respond or give input, or they'll provide resources, book recommendations. So here's an example. If you join these groups, you'll see, you can make anonymous posts, and people talk about it and stuff like that. So I think it's a good resource for you to go and check out and uh, and learn. They talk about 401k brokerage. A lot of good information here. A lot of questions. You get asked questions as well. They provide resources like this Choose FI. I think they even have Choose FI local meetups in different towns and stuff. But one thing is, if any of these people say join this other group, or I invested with XYZ person, XYZ, that's usually spam or a trick. You don't know those person, you shouldn't be even giving them any money or anything like that. So just watch out for that. But I feel like these two resources are pretty good. And then for this overview presentation here, I think some of the good lessons learned I want to tell you about is, if you're looking to achieve financial independence, you need to think of yourself as a business. So earlier, to like what I said, you want to be profitable. At one point, I was going to school and working, and then graduated. I wanted to do real estate, so I was doing my normal job during the day. Then after work, I'd have to go to my properties, either fix it or show it for it to be rented or whatever. Manage contractors, hire property managers, repair people. So if you think of yourself as a business, you need to be doing things to increase your profits, right? You need money. So if you think of yourself as a business, then like I mentioned earlier, you need to cut expenses, increase profit. They may be getting credentials, schooling, another job, side hustle. Because if you keep doing the same thing that you're doing now, you're gonna be at the same income you have to do, or same outcome. So realistically, for example, like Apple, they create new phones. They're working on the next phone, the next phone, the next phone. If you think of yourself like a business, okay, what are you going to do next after this? Okay, what's your next deal? What's your next step in your career? That's what, in my opinion, what I think you should do. Then obviously cut your expenses. You got to look at your expenses. So at one point I had bought like an apartment. The first thing I did was, review all the expenses. Okay, the trash service, the water service, the common areas, and I look to ways to, reduce, renegotiate with the vendors, and then obviously, improve the property, increase the rent. So that's basically what I did, and that's my suggestion for you. Same for second bullet, third bullet. That fourth bullet, record net worth. In that money, in that book, Your Money or Your Life, she talks about that, and I've been tracking, her net worth for many, many, many years. And I thought that was good because in her book, she talks about creating like this poster and, tracking your network through the years. I think it's something you should know also. It becomes like something to track, something to build on, something to see yourself. If you're not tracking it, how are you going to know what your net worth is? I mean, you'll need it also for your, FI number that we talked about earlier. And then track all spending. That way you can know when you retire. So a lot of people say, "Oh, how much money do you need to retire?" Well, well, if you go to a financial advisor, the first thing they're going to do if you're close to retiring is they're going to want you to track all your expenses, because they're not going to be able to answer your question if they don't know how much you're spending. Each person's different. So then they'll use that 25 to 33 times your annual spending to see if you have enough. So you're really going to have to do it anyways, and that's where you can see where you have excess spending. Are you eating out too much? Are you spending too much on groceries? Do you have too much in car payments? You can see uh, where your spend is, and then put in parentheses. If you think of yourself as a business, if you ever had a corporate card, a corporate company credit card, at all the companies I work for, they make you do that once a month. They make you reconcile all your expenses, categorize it. Okay, what was this? What was this? What was this? What was it? Provide receipts and stuff. Obviously, you don't have to provide receipts yourself, but when you categorize your expenses, then you'll know how much you're spending and where at. And then that book, Your Money, Your Life, it talks about your life energy. And I need to open up this spreadsheet, but someone created a great spreadsheet in this link right here. And once you fill out all the information in your budget or tracking sheet, it'll show you like how much each category of your expense is costing you in terms of your life energy. Because let me see if I can pull it up real quick. As it's thinking and pulling up, it shares how close you are to financial independence. So I didn't create the sheet; someone else created it. But basically, the sheet has a dashboard how far you are from financial independence. It tracks your net worth under this tab. You know, you enter all your. This is not my information. This is random, by the way. It tracks, your current net worth. What it's going up, and they break it down in different categories. Okay, like here's my 401k, here's IRA, HSA, Roth, etc., checking, etc., 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 all your debt. So that's how you track your net worth. Net worth is all your assets versus all your liabilities slash debts. And the difference of that is what you have left. If you have $100,000 in assets, but you have $20,000 in debt, then you have $80,000 net worth. But I thought this sheet's pretty good, so I wanted to share it, and I didn't create it, but someone else did. And it has instructions. The initial setup takes the most time, but once it's set up, you just enter what you need to each month and each year. So I have years worth of information. And then, like I was mentioning earlier, you can categorize all your expenses as necessary, discretionary, excess spending, how much it is that your monthly income after your tax, how much you're saving, how much is your investments, how much is your expenses, etc. It's just a sheet someone made. I thought it was so good, so I've been using it. So then we're about to conclude, but what kind of topics does the viewers want to hear about? Real estate investing, portfolio composition. I think this one might be the next video is, you know, how portfolios are composed, some resource I could share there, and explaining how the website's called Portfolio Charts, and how to read the website or how to interpret the data from the website, bank and brokerage bonuses, how to use credit cards for travel, accumulate points. That's currently what I have. So thanks, everyone. Till next time.